going on, folks? Butcher Wall Street. Would explain exactly why AMC and GameStop were down 10% today, at one point more, and why that was extremely important for market makers and institutions. And it's not because there's anything wrong with the stock. Let's put it that way. Neither AMC or GameStop. It's not like because there was any bad news. The reality of the matter is, well, I'll explain that in a second, but you're really going to be happy about this answer. Let's put it that way. I'm going to give people a moment to jump in here. What's going on, ladies and gentlemen? Welcome back. Quant Trades, thanks for being here, buddy. 9 Ether Media, Mike, Larry, Flower, good to see you, ladies and gentlemen. Yeah, I've been getting this question a lot, so I'm like, you know what? We got some answers for everybody. Let's go ahead and give the people what they want, right? A lot of people, nobody expected me to make a video today because the stocks are down. They think, oh no, AMC and GameStop were down, 15% today. Currently down, ended the day around 10%, but are up around 28 to 38% respectively for GameStop and AMC over the last monthly period, basically. What's going on, C130? None of that garbage around here, my friend. What's going on, Travis? Jimmy. Hey, Poitsu. Great to see you. You ready, folks? Let me actually just drop a link here in the Discord so that everyone in the Discord can hop in here. It's called Boss Blunt's Think Tank, for those of you that are unaware. So I'm just going to share this real quick, which I'm doing right now. Andre, good to see you, my friend. Just at everyone live now. That's right, Riyadh. Today is one of the few days that we get to get more shares for a discount, and I truly feel that way. I didn't sell a single share or a single call on either AMC or GameStop. I am sitting tight in expectation that over the next couple of days, over the next 4 to 7 business days, we see some serious price action on these stocks. What's going on, AMC, Trevor? Get in here, folks. Get in here. I see you. Got 147. As soon as we get to 200 at least here, we'll get this show on the road, and I'll explain to you guys exactly what's going on. It's a very clear, easy answer that will make sense to anybody who is well-versed or at least willing to understand market mechanics. Even if you don't understand them right now, if you're willing to think about it and learn about it, you're going to be pleasantly surprised. What's going on, Whopper? Joseph, welcome back. Kirsha, it's great to see you. Yes, absolutely, I can explain what the selling is. I'll give my dogs one quick second to chill out. Fresh, I have both June and July call contracts, my friend. So I'm not recommending anything to anybody. There is a large potential for losses in options contracts of any sort. And unless you're well-versed in call contracts or options in general, or willing to lose money, I don't suspect that anybody should be investing in any stock or call option, because even those that you consider safe, even those blue chip stocks are, of course, extremely risky because you never know exactly what's going to happen. That's right, my friend. You can call me Mr. Clean, but I got a damn better beard than he ever did. That's for damn sure. Let's go, Aaron, Super Steven. What's going on, Super Steven? You're back. That's interesting. We haven't always seen eye to eye, but if you're in here, it must be for a reason. Nicholas, hello, my friend. Nicholas here is one of the top lead investors in XCHANGE. Maybe I shouldn't say how much, but he is the #1 investor in XCHANGE so far, as far as retail goes. What's going on, red memes? I do, in fact, have an egghead. You're not wrong. I'm not mad about that. I have a fucking egghead. Dallas PT added 3,800 shares today at $3.70 at AMC. You are a bloody legend, my friend. That is one way to DCA downwards, dollar cost average. Let's see. Let's go. Hey, SAS Productions. All right, guys. You know what? Come here, beautiful. You want to say hi? Say hello.
Hi.
There you go. This is what's going on, guys. I know a lot of people are unaware about this, but we can explain this move on AMC and GameStop today in 3 letters. 3 letters. And those letters are SSR. SSR. Oh my God. You're crazy.
M-O-I?
What's behind me? I'm in the dining room. That's the butler's pantry right there. I'm just kind of chilling on the dining room table because I got my gimbal connected to the wall. But anyway, SSR, right? Back on topic. Sorry, guys. Yeah, this is my baby that you guys see in the photos on my profile picture. And you guys were there with me the day she was born when I took the photo and posted it on. And a lot of you, including you, Kershaw and Long and JS, etc., you guys congratulated me when she was born, and she just turned 4. And I'm very happy about that. So, huge shout out to KC Shaw, okay? KC Shaw was the one that posted this on Twitter. And as soon as I saw the word SSR, I'm like, duh, that explains everything. When I saw it this morning, I looked at it, and both stocks went down about 12 to 15% in a matter of minutes. And I go, there's no bad news. Nothing is wrong. Something's obviously happening here. And the volume is still through the roof. When the volume is through the roof, it's indicative of the fact that there will be more institutional buying and trading of shares. So, KC Shaw said this, and then I'll elaborate with my thoughts. And I quote KC Shaw. The massive buying pressure from the run-up forced buying from 5/22, May 22nd through May 27th, resulted in orders that needed to be filled, but couldn't be filled due to lack of liquidity. As a result, hey, stop, please. As a result, the market is forced to drive down price by 10% to trip SSR, so that orders could be marked short exempt. And if you guys don't know what SSR is, I'm about to explain that to you. If you're not an investor in the stock market, if you don't own any silver, gold, GameStop, AMC, costs, etc., other stocks like that, this is going to make sense to you. But I still implore you to listen so that you can learn a lot about it. Drop a like for the algorithm if you guys don't mind. AMC had 505,000 shares marked short exempt today. GameStop had 543,000 shares marked short exempt today. Casey continued to say, I recently posted what those numbers were so you could see the difference between a large volume day without SSR being tripped and a large volume day with SSR tripped. Just over 500,000 shares for each stock will now need to be found within the next 35 trading days, or a forced buying situation will arise. This was all perfectly targeted for the beginning of delivery to start tomorrow. Meanwhile, the next phase of a buying and exercising cycle will be starting at the same time. We are about to hit an extremely volatile period in the market as a result. Expect to see some flat downwards trends in price movement for the next 3 to 4 trading days on AMC and GameStop. After that, I guess we will see. It's never just always straight up. Okay, this is all part of the long-term sustained steady buying. That doesn't mean only buying pressure. That doesn't mean every day is a green day. There will inevitably be red days on the stock market, especially during short squeezes, because things like this have to happen in order for institutions to be able to make it easier for them to sell stocks short, to prevent the stock from getting away from them. Okay, now this has been explained. I will explain to you guys exactly what SSR means so that you get a better understanding of it. Casey's post was very good, but it was simplified for the purposes of posting on X. So that's the purpose of this video. It should take me about 5 minutes to explain this. If you don't have a 5-minute attention span, you can leave now. That's totally cool. All right. Wall Street, guys, is sweating here. All right. Retail investors are licking their chops again, just like we were last year and the year before and in 2021 when these stocks ran up 2,000%, 1,800% respectively. And our call contracts for these stocks were up thousands and thousands of percent. A lot of people made tens of thousands, hundreds of thousands, even some made millions of dollars. Hey, I need you to be quiet, please, baby girl, okay? All right, SSR was triggered. We're looking at a powder keg, all right? And the fuse is lit here, folks. And we're going to break it down really easily. And that stands for short sale restriction. SSR stands for short sale restriction, which is the alternative uptick rule. And it's a regulatory circuit breaker that occurs in the stock market in order to slam the brakes on the aggressive short selling when a stock drops 10% or more from its previous day's close. And once it's triggered, shorts can only sell on an upward tick when the price is moving upwards, meaning that they can't pile on and hammer the price down any further during a decline. The rule stays in effect for the remainder of the trading day and the entire next trading day. So tomorrow as well will also be an SSR day, creating like a temporary shield for the stocks. And the SSR was tripped because the prices tanked by at least 10% today. This was done purposefully through wash trades, which are one firm selling it to another and back over and over again using high-frequency trading algorithms, using spoofing and other forms of manipulation and such, which are somewhat legal and somewhat illegal depending on the form there. But there is not an easy way to prove that, for example, Bank of America here in the United States sold shares to Citadel overseas, who sold shares to their conglomerate Citadel partner in the United States, who sold them to another firm in the Cayman Islands, et cetera, and then back, and then right back in the same opposite direction. This causes a stock price to go down when they're buying it at a fraction of a penny or a penny below the NBBO, the National Best Bid and Offer. So SSR was tripped because the prices went down 10%. They were purposely made to go down 10% in order to trip SSR. Okay, you understand that? It was a calculated move that occurred here in order to tie up, that was tied to the massive buying pressure that we've seen from May 22nd to May 27th, and that overwhelmed market liquidity. Goldman Sachs recently sold off 100% of their short puts on AMC as well as Barclays. And they did this to finish up their agreement with AMC, and now they have to buy, and they have to go long the shares. They have to buy back shares. And so that means that there's been a lot of buying pressure, massive volume on AMC. GameStop looking very similar as well. They're both held in these baskets of derivatives. We call them basket swaps. And that causes stocks within those same baskets, like, for example, in this, it would be called consumer discretionary. Consumer discretionary things that are like, things are for fun. You know, KOSS, KOSS, that company, they sell like headphones and such. GameStop, a video game retailer that is now a $13 billion hedge fund that just bought 4,000 Bitcoin today, Ryan Cohen announced. AMC, which is a movie theater. Again, entertainment, right? That's why it's called consumer discretionary. So they're placed in the same derivatives baskets of swaps. Now, in order to clear the jam that we've seen with all the massive buying pressure over the last few days, the market was forced for this 10% drop in price to trigger the SSR to allow certain orders to be marked as short exempt. The short exempt shares are like hidden dynamite, folks. Hidden dynamite. I understand if this sounds a little complicated. I apologize for that. I'm doing my best to simplify it as much as possible. Short exempt shares are a loophole in the SSR rule. When the SSR is active, short sellers normally have to wait for a price to go up, a tick, a penny or a fraction of a penny. But certain market participants, like the market makers, we're talking Citadel, Virtue, Ken Bedpost Griffin, and Dougie Liquidity Fairy Sifu, they can bypass this restriction by marking orders short exempt. Okay? And they mark these orders as short exempt if they're facilitating trades to maintain an orderly market. That's what they claim. But the reality is the only orderly market they're maintaining is preventing their own hedge fund from losing more money. Today, AMC saw 505,853 shares marked short exempt, and GameStop had 543,145 shares marked short exempt. Okay, these are not small numbers. Each short exempt share represents a short sale that did not have to follow the uptick rule. Effectively, guys, this allows sellers to push the price down despite the SSR, despite the short sell restriction. But here's the kicker. The shorted shares must be covered eventually. Regulations show requires that short sellers deliver borrowed shares within a specific time frame, and that is 35 trading days. 35 trading days for fails to deliver. If they can't find those shares, brokers are forced to buy them back in order to close the position. That creates what's called a forced buy-in. Now, 500,000 shares for each stock might not sound like a lot, but in the context of AMC and GameStop, stocks where AMC is held over 90% by retail investors, so there are very few shares available on the market. GameStop is held massively by retail investors as well, and a lot of the shares are DRS'd, direct registered shares. That means that those shares can't legally be traded, although I can't remember exactly who it was. I won't go off on a tangent, but I will explain that one of the brokers was recently, I think it was Webull, was recently fined big bucks for lending shares that were DRS'd. Now, I could be incorrect there. I know that happened. I believe it's Webull though, but that just recently came out just a few days ago. I digress though. All right. So stocks that have a rabid retail following, like AMC and GameStop, and the majority of the stock are owned by retail. They have a history of explosive short squeezes that we've seen happen multiple times now. Okay. And if those shares can't be located, the forced buying could easily ignite a price surge, right? An explosion in prices that makes the 2021 squeeze, in which both of these stocks were up 2,000% each, look like a warm-up act. The mother of all short squeezes is not here yet, folks, but it might be arriving soon. This is a liquidity crunch, and forced buying is like a ticking time bomb. You understand? So some of these X posts that you guys have seen today on Twitter and such point to a liquidity crisis as the root cause of today's SSR trigger. And in my opinion, a lot of the reason why this is happening is, one, because Bitcoin is being purchased up by GameStop. They're a $13 billion hedge fund. And AMC has had their best second quarter in 104, their best Memorial Day in 104 years, and their best second quarter since like 2017 or 2018, which is massive. So, of course, institutions like Goldman have said, you know what, we can't continue to go short these stocks. And so Goldman Sachs and Barclays both sold off 100% of their short puts on AMC and are now going long the call and long on shares. So the buying frenzy, that occurred on May 18th, by the way, the date that Goldman and Barclays sold off those short puts. And ever since then, both stocks are on their way up. So the buying pressure between these institutions and retail investors, options activity, people are buying call contracts, and that's extremely bullish because market makers have to delta hedge when that happens. That means they have to pay up. They have to go out, buy shares, or they have to set funds aside, or they have to marry the calls and puts with puts of their own. Right. Long story. I'll leave it there. We can explain that more on another video like I have in the past. So people are jumping back on the meme stock bandwagon, and AMC and GameStop holders are buying even more, understanding that we're looking at something similar to what we saw last year when Roaring Kitty came back to the community and just set things off like a matchstick on a dynamite. So it's created a situation where buy orders couldn't be filled because there weren't enough shares available in the market. And the low liquidity that we've seen is, of course, a hallmark of these meme stocks, AMC and GameStop, especially when retail investors continue to diamond hand the shit out of these stocks and they're refusing to sell. So in order to resolve this, the market today dropped the prices of AMC and GameStop by 10% in order to trigger the short sale restriction. This allowed market makers to use short exempt orders to fill the backlog. You understand? So these short exempt shares now represent a massive liability for short sellers. If they can't borrow or locate these shares within the next 35 trading days, roughly mid-July of 2020-25, brokers will be forced to buy the shares in the open market in order to cover, potentially driving prices through the roof. Now, this is not speculation, folks. These are market mechanics. This is the way it works. You can read the FINRA and the Securities Exchange Commission and the NASDAQ and the New York Stock Exchange documentation, or you can go ask your favorite AI and ask it for yourself. You know, if you don't feel like reading all those tens of thousands of pages. We've read them. We've done those due diligences on it for years now and are very well versed in these things. So these market mechanics that we saw, for example, in 2021's GameStop and AMC short squeeze, saw GME's price skyrocket from $17 a share to over $500 a share pre-split. That's $125 or so split adjusted, because short sellers were caught in a similar trap, with 140% of the float shorted that we know of and nowhere to hide. That 140% is almost exclusively due to Melvin Capital. All of the short swaps and derivatives that we saw that collapsed Archegos, that made them go bankrupt, and many other hedge funds, and also Credit Suisse as a byproduct of holding the toxic bag of derivatives from Archegos, went up to Credit Suisse. Credit Suisse went bankrupt, and now UBS owns bought all that shit and still has that legacy costs, still have all those toxic bag of derivatives that they have to unwind from GameStop and AMC as well. That leads to UBS to be in a terrible position, and that's why they had to ask the Swiss government for a guaranteed $8 billion in order to cover their losses in order to take over Credit Suisse. And of course, the Swiss government, understanding exactly what was going on with Credit Suisse and Archegos and AMC and GameStop, agreed. So UBS at least has a lifeline there. AMC followed a similar trajectory because it surged from single digits from $2 a share to $78 a share in intraday trading at its peak. And the current setup that we're seeing right now, with 500,000 short exempt shares each, could force history to repeat itself if the liquidity remains tight and retail buying pressure reignites. Folks, if retail investors don't sell their shares of AMC and GameStop, we're potentially looking at another 2021 short squeeze or better, right? I mean, worse for the short hedge fucks, but better for retail investors. So let's explain why this is insanely bullish for AMC and GameStop. We're looking at over 500,000 short exempt shares for both stocks, respectively, individually. So that's over 1 million shares between the two. And that's a ticking time bomb. If they can't be delivered, the forced buy-ins will create this cascade of buying pressure. And that buying pressure will create retail investors to buy more call contracts. And that will then cause market makers to go and marry some call contracts with put contracts and further have to delta hedge. And basically, delta means money, right? And they have to hedge by buying more shares and buying more call contracts as well. So, with retail investors still holding significant portions of the float, 93% of AMC investors were still holding in 2023 as of that most recent share count, and a ton of GameStop shares DRS'd. The supply of available shares is already massively restricted. Do you understand? So, SSR doesn't stop shorting entirely, but it makes it harder for shorts to slam the bid down and drive prices down more aggressively. And so for the next 2 trading days through May 29th of 2025, short sellers are forced to sell on upticks, and market makers are forced to mark short sales as short exempt if they don't have enough shares. That means that they might get the price down now, but over the coming days and weeks, they're going to have to buy more shares, causing what? What happens? A further price increase. They're going to try to buy them in dark pools, naturally. And because of that, retail investors have to learn how to route their orders. The problem is that most brokers don't allow you to route your orders, and the ones that do make it extremely complicated. That's why we created LitXChange. LitXChange is an upcoming stock and crypto brokerage that is currently doing a Reg C raise, where over 375 retail investors have already raised over $750,000, and you can actually own the company. There's a link down below in the description to litexchange.com, and you can find us on the FINRA regulated funding portal. So that is the only way to get orders automatically routed to lit markets. That will be the only ways upon launch. So X posts here, like Casey Shaw's and others, are depicting this perfect timing if GameStop or AMC announces something big. For example, today Ryan Cohen announced the acquisition of 4,000 Bitcoin, right? Or AMC announcing a convertible bond deal or some more strategic move that could trap shorts even further. And so the chatter that we've been hearing hinting that there's an upcoming buying and exercising cycle starting tomorrow, May 29th, likely refers to retail investors buying shares or exercising their call options that are in the money. And that, of course, forces market makers to buy shares to hedge. And in 2021, a gamma squeeze, the momentum that's driven by options, amplified the GameStop and AMC rallies massively. That's why you had a lot of people out there that were paid by the short hedge funds telling you to stop buying call contracts. Because they said, quote, it gives free money to the market makers. No, it doesn't. It forces them to spend more money to delta hedge in order to save themselves from the gamma that is blowing a rocket up their ass. So retail piles into calls during these volatile period. It could create a feedback loop of buying pressure. And so both AMC and GameStop have defied gravity before multiple times. We're not talking once, twice, 3 times, 4, 5 times now. We've seen these stocks go up 500, 1,000, 1,500, 2,000%. And those same call contracts, for example, like sometimes the ones we were talking about, let's just say 2021, for example, June 2021, I was buying call contracts on AMC, 200% out of the money for $21. And at the height of the squeeze, those were worth $6,000 plus each. This is not rocket science. This is market mechanics. And although that's very uncommon, it's not impossible. It's happened before, and it's likely to happen again in much more explosive fashion, especially now that retail is much more educated. So retail on platforms like Reddit and Twitter and stuff, Wall Street Bets, etc., crushed hedge funds like Melvin Capital and Archegos and a bunch of these other pricks that lost over 50% in the first quarter of 2021 and then later had to sell their positions to Citadel in order to maintain Citadel solvency. And the current setup with high short interest, low liquidity, SSR mirrors a lot of those same conditions that we were seeing, guys. I'm seeing the exact same fucking thing that we saw last year and in 2022 and 2021 multiple times. Retail investors at this point are much more educated and battle tested and hardened and aren't scared like a lot of the newbies are in the stock that understand, like, hey, these are volatile stocks and we're here for it. That's a big part of the reason why people are doing this. And so the potential for a repeat is sky high. Sky high. I'm not saying it's going to happen tomorrow, but it could. It could happen tomorrow, next week, next month, So the extremely volatile period ahead that we've seen has already begun. And we're talking on the ups and downs and the flat to downward price movement for today and potentially the next day or two could be followed by a potential explosion that almost always happens in the after hours or in the overnight session when retail investors can't buy. The volatility here, folks, high volume and volatility is a meme stock's best friend. Silver, gold, GameStop, AMC, and so on. Finger, right? FNGR, QNTM, OCGN. I could name a bunch. You guys probably already know them, right? That's what leads to these attention-drawing, FOMO-fueling, price-amplifying swings, okay? And if AMC and GameStop stay in the spotlight, retail buying could overwhelm these shorts again, especially with this 35-day clock ticking on the short exempted shares. This is Wall Street's worst fear, folks. Imagine this. In 35 trading days, sometime around mid-July, the 35-day window for delivering those short exempt shares is closing. Short sellers start scrambling, and the float is locked up by these diamond-handed retail apes. All of a sudden, brokers start issuing forced buy-ins. And suddenly, we're talking millions of shares will need to be purchased in a market with no sellers. The prices could easily spike $10, $20, $50, $100, $200 or more. And then social media, what's going to happen? It's going to blow up. It's going to hit the news. It's going to be on Charles Payne, Fox Business, etc. Hedge funds are going to bleed billions and billions of dollars, just like in 2021, while retail investors cash in. And this isn't a pipe dream. This is something that's happened before. It's happened. It's extremely highly plausible that it's going to happen again, given the current setup. So the shock factor comes from the sheer audacity of retail taking on Wall Street again, folks. All right. People haven't sold. They're understanding that what's happening here is financial crime. They're understanding that short sellers and market makers and hedge funds and family offices are manipulating your pension, your 401k, your stocks, your thrift savings plan, your IRA, your ISA, your equities, your crypto, your bonds, you name it, your precious metals, your silver and gold. Our 97% of silver and gold derivatives are traded in dark pools by banks. And the only way to stop it is to route your fucking orders to lit markets. Because sure, I own precious metals, physical precious metals, silver and gold, but I also like having the ETF. I also like having leveraged ETFs. It's great. It allows me to get more bang for my buck. And they're way oversold and they're way manipulated. But if you were buying those on Lit Exchange, when we launch, Lit Exchange will give you real shares from real people, from lit exchanges, the New York Stock Exchange, the NASDAQ, etc. What does that cause? It causes banks and institutions to not be able to manipulate those stocks in the same way. It prevents them from front-running your orders so that they make money and you lose money. It prevents them from processing your order together with hundreds of thousands and millions of other shares at the same time through a dark pool, invisible, making it seem as if you didn't make a damn bit of difference in the stock price. So that your actual funds, your money, affects the stocks and cryptos that you're buying and selling in the way that it should. It's really that fucking simple. We're looking at a real concrete situation here, in my opinion. And, The short sellers are going to exploit loopholes, guys. They're going to short through ETFs. They're going to short through dark pool. They're going to process orders in dark pools. They're going to keep pressures on prices. They're going to spoof, and they're going to wash sale and wash trade. It's going to happen, for sure. But the broader market's volatility could easily distract from meme stocks if bigger macro events take place. But there's also the risk that short exempt shares get covered if liquidity improves, if retail investors keep buying stocks, if institutions keep buying shares, if people keep buying call contracts and exercising calls when they go deep in the money. Retail enthusiasm here is obviously high, right? Some investors might sell early, diluting the pressure on shorts. There are a lot of paper-handed bitches out there. But that doesn't mean that it's impossible because it's happened before multiple times and it's likely to happen again. Now, we've seen Robinhood, IBKR, Webull, E-Trade, etc. Hundreds of stock brokerages restricted trading and took away retail investors' ability to buy. And there's potential that could happen again. The fundamentals are fantastic, fellow from this town. You should take a look at that yourself, my friend. I think you learn a lot. GameStop is now a $13 billion hedge fund. AMC is profitable for the rest of the year and is making buku bucks and investing a lot of money into upgrading their theaters. And I could go on and on. I've done the earnings calls for both companies here almost every single time, every single quarter, I should say. But I will leave it at that, folks. I wish you peace and wealth. I'll see you here tomorrow. Cheers, my friends. We're going to be so fucking rich. Cheers.